Most people have heard of bonds. Very few can actually explain what they are. Here's the simplest version. A bond is a loan. When a government or company needs to raise money, instead of going to a bank, they borrow from the public. You hand them money, and in exchange, they promise to pay you back on a specific date, plus interest along the way. That's it. Stocks are ownership, bonds are loans. When you own a stock, your return depends on how the company performs. The price can go up, down, or to zero. When you own a typical bond, the deal is more fixed. You know the interest payments, you know the date the borrower is supposed to pay you back. The biggest risk is whether they can actually do it. That's why bonds are usually considered safer than stocks. And it's also why they usually pay less. Less risk, less reward. The biggest and most important bond market in the world is the U.S. Treasury market. When the U.S. government needs money, it sells debt to investors, banks, and other countries. Treasury debt is treated as one of the safest assets in the world, which is why so much of the global financial system is built on it. Companies issue bonds too. These are called corporate bonds. They usually pay higher interest than treasuries because companies are more likely to default than the U.S. government. Here's the part most people miss. Bond prices and interest rates move in opposite directions. If new bonds pay 5%, your old 3% bond becomes less attractive, so its price falls. If new bonds only pay 2%, your old 3% bond becomes more valuable, so its price rises. That seesaw is one of the biggest forces in the entire financial system. Stocks get the headlines, but bonds are quietly running the show.